Hello, I'm Dominic Hobson, co-founder of Future of Finance. My guests today are Benedikt Schuppli, co-founder and co-CEO FQX, and Daniel Killenberger, CTO at FQX. FQX is a Zurich-based fintech whose ambition is to digitize corporate debt so it can be registered, issued, transferred, and eventually traded on a blockchain infrastructure. Benedikt and Daniel, thanks very much for joining us.
Thanks for being here.
It's great talking to you. Thanks.
Benedikt, perhaps I could start with you. I've just referred to corporate debt, digitizing it, but what fundamental problems in the debt markets is FQX designed to solve?
Thank you, Dominic. So if we look at the debt markets, which are some of the oldest markets in the world, historically they've grown to become extremely fragmented, and liquidity is stuck in silos. So that is in national silos. We have different legal frameworks, depending on whether you have a bond in Germany or whether you have one in the US. And then we have fragmentation across instruments. So a bond is registered on an entirely different infrastructure than, for example, a loan or a certificate of deposit is. And so this fragmentation, vastly informed by national legal jurisdictional silos, just I think inhibits the true potential of the global debt market. And then of course this legal inefficiency comes with a lot of infrastructure inefficiency, where we just see in order for a bond to actually arrive at the end investor, from the point where it's issued from the borrower, it takes so many different steps and so many intermediaries. And we believe with blockchain technology, we can vastly alter the way corporate debt is being issued.
Now, as you've just said, corporate debt takes many different forms. There's loans, there's certificates of deposits, there's commercial paper, and promissory note is a generic term which can cover all those different varieties of debt. Now, is your own concept of an eNote, is that sufficiently flexible to cover all those different facets of the debt markets, or just some parts of it, some of those varieties, or all of them?
It's an excellent question, Dominic. So the idea behind the eNote really is that we have a kind of one and all generic corporate debt instrument, which can cover a variety of financing purposes. Now, of course, as a startup, we have to apply focus when going to market, which is why we focus on a niche that revolves around short-term debt, as it's not as much catered to and it's not the most competitive market, or one of the most ones like the bond market is. Now, in terms of what the instrument can cover, this goes back to the previous question, and that is, we believe the instruments itself that are on vastly different infrastructures actually have also grown to be this different historically. And we believe some of these delineations which separate a commercial paper from a bond, from a certificate of deposit, are much more artificial than they are inherent by nature. And so if you can actually create an infrastructure that is level playing field and is blockchain based, we believe we can fulfill most of these financing purposes for which a bond, a commercial paper, is used with one and the same instruments. And you achieve a much higher flexibility and modularity on the side of the issuer. So, an issuer can just switch between short-term and long-term. It doesn't mean it becomes actually a different instrument. The issuer can switch between, just having one investor, having a bilateral loan, over to having hundreds of investors, making a kind of a commercial paper or bond product. That's our vision.
Now, your initial focus has been on short-term debt, i.e. debt instruments which are less than a year away from maturity, money market instruments, and trade and supply chain financing. What was the reason for that? Why didn't you go straight to long-term debt as well?
So the great thing about the promissory note is its abstract nature, right? It's an unconditional promise to pay. And this means that it has some superiority compared to instruments which are very prevalent in the factoring or supply chain finance space, because they're most of the times just receivable space, and you don't actually have an abstract unconditional promise to pay. You don't have really an instrument or a debt instrument. That's why we figured this would be actually a great niche to start alongside corporate debt. But we then also realized over time, and I think that's just some of the things you have to do as a startup, is fail and learn and adapt, is that the market is not flexible enough to really embrace innovation of the kind that we offered. So we wanted originally to also work with financial intermediaries offering supply chain finance solutions to corporates. And you could tell, although many of these corporates are in dire need of innovation, they don't have the culture to embrace it. And this is why also we have focused now on more corporate debt, actually, and less supply chain finance, and also are going much more in the spirit of digital asset, because culturally, these companies are much closer to us as a blockchain startup.
Do you have plans to extend into the long-term debt markets, by which I mean to include fixed rate, term bond issuance as well?
Yeah, so absolutely. I think once we've established our instrument as a market standard for blockchain-based debt issuances, focusing on short-term debt in the initial phase, we will then venture out also into the long-term market. There is one, I would say, caveat to this. We thrive on standardization. So the more standardized an issuance can be, the better for our instrument. If we go into the really long-term space, syndicated loans or long-term bonds up to 10 years, they're oftentimes so customized that it's difficult to leverage blockchain technology and standardization and digitization to really make it worthwhile. So that's why I think a natural caveat is in there somewhere.
And you just mentioned the difficulty of servicing very long-term bond issues, but are there other challenges apart from the duration issue? In other words, do they make more demands in terms of asset servicing? When they have coupons, those coupons may be variable, they may have redemption schedules and so on. Is that an obstacle to getting into the long-term bond markets as well, those sort of issues, the asset servicing side?
Absolutely. I think from a mere technical perspective, right, the more kind of payment flows in one asset life cycle we have to include, the more complex it gets. And that's why also our initial product that we've already gone to market with are zero coupon instruments, where we basically only have two payments, and that is the issuance and the redemption. And we don't have any interest bullet payments in the duration. Now we understand that many investors are used to this, but also over time, we can cater to both. We can have interest paying loans, but we do actually believe the standard will then err to actually just the zero coupon instruments in the short-term space.
Now, Daniel, perhaps I could bring you in at this point. This is not just theory we're talking about here, this is practice as well. And the recent Babel Finance eNote issuance, which raised USDC, that indicates that FQX is moving into digital lending, something that Benedikt referred to a minute ago, using stablecoins and possibly cryptocurrencies as well as collateral. Now, how important is that as a potential market for FQX in the long term?
I think I will elaborate quickly first on the short term, which is that we're actually quite focused on exactly this kind of markets to begin with, in a certain sense, that our new platform will cater a lot to the stablecoin kind of lending applications. And we do that because we, as a company, believe in the future of finance being mainly on the blockchain as tokenized assets and currencies become more prevalent. And this is mainly for the reasons of transactional efficiency, but also just for custody reasons, that clients and users are able to hold those assets directly in their wallet, which, as we've seen in the recent kind of meltdown of centralized finance corporations, which have lost customers' assets, given that they were managing them and customers didn't have direct access and not direct custody. You can see how problematic centralized managed assets can be if they're not properly managed. And yeah, given the future outlook, stablecoins and tokenized assets are something that we're really focusing on, both in the short term and the long term. So, yeah.
As you mentioned a minute ago, you are focused on digital assets, tokenized assets being issued onto blockchain networks. Now, where that has been happening in the recent past, in the DeFi markets, for example, all those issues have been collateralized. So are your issues going to be fully collateralized, partially collateralized, or even uncollateralized? Are you going to follow that DeFi model?
Yeah, so we're gonna follow the DeFi model in terms of it feeling like a DeFi experience, but we will distinguish ourselves by really backing the token by this legal claim, which so I think a good way to explain it is that in the Sunny case, everything goes well. You go through a process that feels like DeFi, where you deposit your investment, and after a certain point, you will redeem your yield, and it will feel all like DeFi. The difference being that you don't have to necessarily provide collateral as an issuer of the debt instrument. You can do it completely uncollateralized, given that in a worst case scenario, you have the legal backing of the underlying token, which you can then enforce that claim in a court of law. So there's the two aspects here are really the thing that we think distinguishes us from potential other companies, is that we do the DeFi experience in the Sunny case where everything works well, but in the worst case scenario, you do have this legal claim which will cover you in case of a default or a similar scenario.
Maybe to add to this is really we have built an instrument that covers really the full range, from fully, or even if you want so, over collateralized to completely unsecured, right? And this is just in the end kind of a spectrum from, if someone wants to go unsecured, obviously they will have to deliver some kind of proxy or credit rating. We can facilitate this by providing anything from a Moody's credit opinion to a fully regulated short-term rating, which is provided by some service providers in Europe, all over to then just a secured and collateralized transaction. Overall, because we provide this globally enforceable and secure legal framework, we believe we can lower the loan-to-value ratio and just create more capital efficiency. And I think that's the gist of it.
Now, you both said in your different ways that you can do this uncollateralized, which makes it very different from the DeFi markets, where have been characterized, if anything, by heavy over-collateralization. So you are saying, are you not, that you can actually reduce the size of haircuts on average? In some cases, they won't exist at all, but in other cases, they will be much lower than that very heavy over-collateralization we've been seeing in the DeFi markets. Is that right?
Yeah, that would be correct. Yeah.
Okay. Now, how do you go about finding? You've got to find investors as well as issuers. How do you go about finding investors, and how do they express their interest in lending to the issuers which you found?
So I think there's multiple ways of investors finding opportunities to invest in. So firstly, there's the way to come through third-party integrations, and they've already found their counterparties and are submitting those the wish to invest through a third party into our API. On the other hand, we will also emphasize more our own platform with a marketplace where investors and borrowers can find each other. And also, of course, we're going to be looking to directly coordinate some of the liquidity and work with are working to line up partnerships to have the liquidity provided into our marketplace. So yeah, that's the main avenues we're looking at right now.
Now, one of the things you're looking to provide those issuers with is flexibility. In other words, they can issue notes to one investor, or they can, i.e. bilaterally, or they can issue notes to dozens of investors, do it multilaterally. And you also want to give those issuers the benefit of being able to, particularly if they're coming to the market very frequently, and very big issuers will be in the market on a weekly basis almost, you can cut those issuance costs, which will be extremely valuable to those issuers. What are the difficulties? What are the barriers to actually making that happen? And I'm thinking here really not of technical barriers, more of legal and regulatory barriers to allowing an issuer to do a bilateral issue here, a multilateral issue there, and to do them sequentially and frequently. Have you encountered legal regulatory barriers to making that happen?
Well, thanks so much, Dominic. I think this is really a very poignant question. And if you look at kind of the evolution of blockchain finance, decentralized finance, starting from the ICO era over to DeFi or CeFi, people have always tried to circumnavigate securities regulation, right? And they've tried to argue, sometimes in very exotic fashion, that their tokens, although very clear investment vehicles, should not be considered securities from perspective of many different legal frameworks around the globe. FQX has done a lot of groundwork to enable the product that we offer, and so we can actually offer fully regulated debt securities, something which really barely anybody else can in this sense. And that is because we've done the mapping for the past 2 years, making actually sure that we can account for the difference, because you're absolutely right. A bilateral issuance between one investor and one issuer in most cases does not qualify as a security. It may qualify as a regulated banking business or a lending act, etc., but it mostly does not qualify as security. If we venture into offering a series of standardized notes, emulating a bond or a commercial paper, very clearly in most jurisdictions around the globe, this will be qualified as a security. And we have a number of measures that we take to mitigate the risk and make sure that what we offer is compliant. And this can be, from just restricting it to a qualified investor base, over to making sure that it's a private offer, not a public one, as it relates to prospectus obligation, etc. So there are barriers, but we also know because of these barriers, there's a large opportunity out there. And yeah, we've done the work, both the legal engineering, the technical work, to make sure we can master those.
And that legal engineering has been in Switzerland, or has it been in multiple jurisdictions?
So we have flexibility to actually offer several jurisdictions, both as they relate to which investors can we address, which issuer base can we address, which applicable law can we offer. Most of our work, research, non-action letters by financial authorities or financial conduct authorities has been focused on Switzerland, European Union, UK, and then some, let's say, digital asset heavy markets like Cayman, Singapore, and Hong Kong.
Okay, that sounds difficult. Also sounds expensive, working all that out.
Yes.
But you're also not entering a marketplace which is completely de novo. You're entering a marketplace where there are existing sources of short-term finance, cash-rich banks, increasingly asset managers are willing to fund corporates as well. What's been the reaction of the, if I might call it, the traditional short-term finance industry to your emergence, to your plans?
So I think we've seen quite a full spectrum of reactions, from huge enthusiasm, especially, I guess, product experienced people. They see the benefits, that on the one hand, we are conflating huge inefficiencies on the infrastructure side, and we can create by bringing everything on one infrastructure and on a blockchain basis, we can deliver so much customer value. So many see that, and I think this is where the space is going, and it's kind of an inevitable direction. And others, of course, I would say, are more protective of their own business. They fear that this may have some cannibalizing effects. We feel it's less the case in the short-term space than in the long-term space. But even here, right, when talking to banks, some of let's say their head of corporate banking may fear that this would actually start competing with their revolving credit facilities, and others may think that this would compete with some of their investment products. But if this is the kind of spirit that you embrace, then you're never going to be able to master innovation and the changing times that we live in. And so at the same time, we're so happy there's so many innovative financial institutions out there, both from the digital asset space and also from the TradFi space, that are aware of this, and they know this is an inevitable change and they have to prepare for where it's going. And with those, we are working together, and we are continuously going to work together.
Now, Daniel, can I ask you a question about, I suppose it's distribution really to issuers? As I understand it, issuers can access your infrastructure, the FQX infrastructure, directly, but they can also access it via intermediaries like Instamatch, CLST, and SIX, the Swiss Stock Exchange. And presumably there will be other third-party distributors or intermediaries, if you like, which you'll be willing to accommodate other exchanges even. Now, as you look forward, do you expect those indirect methods of accessing your infrastructure to be more important than people coming directly to the platform? And maybe a different answer to that in the short term to the long. But what are you expecting indirect approaches to be more important than direct approaches now and in the future?
So currently for our indirect approaches, we're actually focusing a lot of the issuance to happen within a CSD, but and that's where the traffic from from integrations is coming from mostly. In the near term and in the future, we're actually expecting to be growing our platform issuances directly with customers directly through our platform, using the direct approach and the blockchain as the most efficient way to issue notes directly to investors. And we're expecting to grow this market together with the blockchain ecosystem as this grows as well, and it gets more established and more recognized. We're also expecting to then grow into what is currently the traditional finance, which will then be able to use the blockchain infrastructure as the efficient settlement layer, which it is.
Now, FQX, like everybody else, including the cryptocurrency industry, is captured by the FATF recommendations on money laundering and countering the financing of terrorism. Now, you're going to have to put issuers and indeed investors through some sort of vetting process. And I understand you've got this whitelisting idea. Are you going to be doing this yourselves, or are you going to be relying on third parties to do those checks?
So we are currently building the KYC and KYB process. Some of that will be internal, and some of that will work with third parties. And we'll be looking to automate a lot of that as well. So with third parties, so that the experience of onboarding is as smooth as possible. Now, given the whatever onboarding path ends up being chosen for the company, we will then be issuing technologically we'll be identifying companies using actually NFTs or using NFTs to identify companies to be able to participate in the programs that we're deploying to the blockchain. So you can imagine the protocol itself being open, but us as a service provider, when we deploy such an issuance program and us being the authority to authorize such programs to happen, we will only authorize those programs to happen if you show up with such an identifying NFT. And no matter how what process needs to happen on our platform before, so in terms of KYC, AML, we can reflect this in the NFT or even on our platform directly to see that you're fulfilling those requirements and are able to participate in these programs. Even though the protocol is open, we can still, as the authority on those programs, steer who's able to participate based on these access control rules.
Would it be very misleading, Daniel, to regard your NFT model as akin to a digital identity?
Well, it's not directly an identity, given that you're not going to be able to directly inspect and see who this entity is, right? So this is more of it's going to be pseudonym, and it's going to be able to, so that the program knows if that NFT is in possession of this wallet. It's been identified by the authority, which is us, and is then allowing participation. So in one sense, we know it is an identity, but for the general public looking at the blockchain, they cannot inspect directly to reverse engineer the identity. So,
right. So you get the benefits of running the checks, but they also get the benefit of not having to disclose who they are, or
the identity will not be directly disclosed to the public blockchain as such. Yeah.
And am I right to think, from what you've been saying, that issuers and investors can work with third-party providers, which you have kind of approved because they provide a good enough service? That may be one for you, Benedikt. I don't know. Can an issuer and investor choose who runs those AML, CFT, KYC checks?
So certainly the goal post would be to incorporate as many existing providers as possible, so we can really cover as many the broadest user base possible. And many of these services, right, it would be I think not prudent as a startup to build all of this yourself, trying to reinvent the wheel, because a lot of excellent groundwork has been done. Some really, really great products are out there in the market, and we just need to enable these products and incorporate them into our service offering, so you can really bank on all of the work that has been done.
Daniel's begun to talk about this, but what are the benefits of that whitelisting process, both for issuers and for investors?
So the benefits are, I think, clear to the network effects you can generate, because just very logically, we're going to create more efficient markets by allowing more potential issuers to participate and more potential investors to participate, thus increasing liquidity available, and thus really creating more efficient markets, lowering transaction costs. And I think this is something that underlies most of our product features. The idea and the spirit to lower transaction costs to generate more efficient market conditions. And that's why also, for example, we enable the connection also with CSDs, such as SDX, because this way we can tap into more institutional liquidity, which otherwise wouldn't be able to participate in some of these blockchain-based debt instruments.
Just very quickly, before we leave this subject of whitelisting, you referred to having a RegTech engine. Is the whitelisting what the RegTech engine does?
Thanks for bringing that up. I think the whitelisting will be part of the RegTech engine. The RegTech engine is a concept that is associated with the notion of compliance by design, right? So if you look at how regulatory authorities worldwide, so whether it's the Financial Conduct Authority in the UK or BaFin in Germany or the SEC work by kind of instilling fear and with sample rates. But it's a hugely inefficient work, because either They're going to have to find kind of like, the bad apples that actually violate securities law, but they're not often actually going to find all of them. So we have to assume there are so many unregistered securities offerings and violations of securities law, especially as they relate to a cross-border basis. Even more so in the vastly unregulated crypto and blockchain space, where we know insider trading is a huge problem, front running is a huge problem, and unregistered securities offerings. We believe that regulation that is here to protect markets and consumers makes totally sense, and we can actually use and leverage blockchain technology to make this regulation more efficient. What I mean by this is you can envisage now what we call the programmable security. So you have your blockchain-based eNote, which is, let's say, a short-term bond, and we can program regulatory logic into this token by using smart contracts that say this token may never end up with a non-qualified investor, or this token may never end up with a US-based investor. And before, you would actually really have to rely on, as the conduct authority, on sample rates. Even you as a financial services provider had to have huge legal teams making sure you don't violate this law. And here we can actually bring the emphasis to the programming and just create compliance by design. And I think has a huge, huge potential to also change the way financial system works and how they interact with the law.
You've talked quite a lot about law and regulation, and you've made it pretty clear that the issuers of eNotes onto your blockchain platform are going to be doing so on a fully regulated, fully compliant basis. Now, one of the regulations in Europe insists that securities, which is what we talked about earlier in this interview, securities have to be issued into a CSD. Now, I understand you're working with the two principal digital CSDs in Europe. That's SDX in the Swiss Stock Exchange digital CSD, but also with D7, the Deutsche Börse digital CSD as well. And Daniel referred to this earlier about CSDs being an important vehicle for the growth of your business. What does issuing into a digital CSD mean for issuers? What do they get out of it, as opposed to complying with what the regulation says, with what CSD law in Europe says?
I think the issuers, they can benefit from the fact that the digital CSDs, they work more efficiently. And we believe that, this is now just the beginning. First of all, I think we will see a big shift of many other CSDs moving to digital asset-based technology, some of it Web3-based technology, some of it not. But then overall, the CSDs itself, I think, will also stand a challenge in the future, because the future is pushing towards bringing issuers and investors more closely together. And a CSD inherently has a high level of intermediation. And so we know right now, however, the way the law is written, many of the institutional investors, they can only invest if the assets are in a CSD, if they're provided to them in a regulated delivery versus payment. And there's a lot of benefit to that in the short term. We believe in the long term, a lot of these precautions can be replaced by technology, specifically Web3 technology, such as smart contracts and blockchain-based debt instruments. The benefits for the issuers right now are they can nonetheless benefit from a more efficient system if they use the digital-based CSD. They can actually build understanding, learn how to educate or how to interact with a Web3-based financial system. And I think this will also, make them ready for once we enter a kind of a further step of decentralization in the future.
Benedikt, as you say, the logic of the technology is to bring issuers and investors close together, and therefore the end point here must be issuers issuing directly into digital wallets controlled by investors on a blockchain network, whatever the law and regulation currently says. And you were starting to give a flavor there of the type of issuer, the character, if you like, of the type of issuer who wants to experiment in that way. Is it very obvious to you what the characteristics are of that issuer who's prepared to issue directly, as opposed to that issuer who would prefer to stick to the tried and trusted method of issuing into a CSD. Are you seeing those two types emerge already from the issuers you're talking to?
I think that's a really excellent point of discussion. I mean, there's an obvious candidate, which is, blockchain companies as issuers. This could be a wide variety from, blockchain or crypto exchanges, which are in need of additional liquidity. This could be, crypto market makers. This could be your crypto trading firms, all over to crypto lending platforms. Or another interesting candidate is the crypto foundations, right? Which still have vast amounts of liquidity, many of them, but their asset value have taken a dive, and so they don't want to liquidate their current assets at this low, and so that's why they want to have non-dilutive external funding from debt. And previously, crypto foundations were not able to tap into regulated securities markets. We can actually offer that they can tap into the market and issue a blockchain-based commercial paper. So the obvious candidates are blockchain companies, which have a proximity to the technology. They trust the technology, and they don't necessarily need to trust in traditional institutions. But I think there's there's a spillover effect, and that goes to, in general, tech companies, because tech companies are built very differently from other more traditional companies, because they're built on the premise of efficiency. And when we talk to tech companies and many techies, they do not understand the way the current financial system has been built up. They can't wrap their heads around these layers of intermediation and inefficiency, and that's why they might not be blockchain companies, but they understand the spirit, and it has a very clear benefit, and that is just a cost and efficiency factor. Because with the direct issuance, we can deliver 10x factor in terms of cost. We can deliver 10x factor in terms of user experience, go to market in terms of how long an issuance takes, self custody, etc. So over time, I think the spillover will then come even to more and more traditional companies, but they of course are not going to be the first movers. So first movers are blockchain companies, and then generally tech companies.
As you say, many of these blockchain companies come from a culture, a background from the old ICO era, in which the purpose was to cut the costs, cut out the intermediaries, go directly to the source, if you like. Now, do that group of issuers understand the benefits? And I'm talking here about another aspect of CeFi, if you like, the traditional world of finance. I'm referring here to the use of unique identification numbers, ISINs, International Securities Identification Numbers. Is that a service you're going to be providing to issuers of eNotes? So these eNotes going to have ISINs?
Yeah, so I think generally this will be opt-in. The issuers, based on their type of investor that they're targeting. As an issuer, you need to have a kind of idea, who am I targeting with my offering? If they say, these are your traditional financial investors, they're going to be very happy having an ISIN number. For some of them, it's going to be kind of a nice to have. For some of them, it's going to be a requirement, right? But then the requirement oftentimes comes with more. It has to be in a CSD, it has to be delivered or catered, provided by delivery versus payment. So FQX can already cover ISIN issuance in a number of jurisdictions. If it's going to take place in the CSD, then the ISIN issuance will be covered by the CSD itself. If it's going to be off CSD, we can cover that in a number of jurisdictions. Some of them, it works in a more automated fashion, where we have contingencies of ISINs from the local national numbering agency. In others, it's a more manual process. But as we go, it's definitely the idea to build this network globally so that the issuer can freely choose should this issuance have an ISIN number or not.
Now, those ISIN numbers will be very useful in secondary market trading. We've talked almost entirely so far about the primary market, about issuance. And at present, as I understand it, you don't provide a secondary trading platform, just a notice board, an OTC notice board for investors to sell or advertise for sale their eNotes. What does that mean? You're presently, with your focus on the short-term finance market, are you basically operating in a market which is a buy and hold one only, and you'll start to develop the secondary trading functionality as you get into longer-term forms of debt, or does it mean something else? You probably both have views on this, but maybe Benedikt first. Sure.
Thank you so much, Dominic. Yeah, I think you've put it quite well. This is the outset. Is because we said, we want to focus on short-term debt in the beginning. Very naturally, there's going to be a bigger emphasis on primary issuance compared to secondary market trading. But there's two caveats to this. The higher the issuance size will become, the average issuance size, and the bigger the brand of the issuer, the higher the need for a secondary market to come into existence. And so as we move on to then larger issuances, larger issuance sizes, more recognized brands, even still if we go to 6 months or 12 months maturity, there will definitely be a secondary market out there. And I think there's a great need for that. So we will see the emergence of, let's say, let's say you have your biggest crypto trading company with a couple of billion in market valuation or market cap. If they will issue a 1-year note, I'm pretty convinced there will be enough market data and interest to create a secondary market around that. If we move further up the ladder, let's say have Coinbase issue their first 1-year eNote, then there will definitely be a very interesting secondary market around that. Daniel, over to you.
Yeah, especially if you go into more higher fractionalization, so you split the total value of the initial issuance into many fractions, you can see how this becomes a liquid market quite quickly. And it's also one of the reasons why technologically we've decided to go to Solana initially, is because we're anticipating having a secondary market in that way. So once the volume, as Benedikt elaborated, becomes big and the fractions big and the fungibility becomes real with higher volumes, on Solana, given the standard token program that's been established as like a standard that we're also deploying and using, it becomes almost trivial to deploy an order book directly on the blockchain using something like Project Zero, and could also then be directly integrated into our platform, or potentially also offered on other platforms as secondary market solutions. So definitely something we're anticipating, but you're right, currently starting with the short-term debt, if you have one note, it's not going to be necessarily something you'd be looking to sell on the secondary market with an order book. But yeah.
A full secondary market trading services is a natural evolution of what you're doing, is what you're really saying, right?
Yeah, it's a natural evolution we're anticipating.
Now, we've talked about the primary market. We've now talked about the secondary market. What about the third stage, if you like, which is the clearing and settlement of transactions in eNotes, and indeed issues have to be bought and sold as well. So how is the settlement process going to work?
Yeah, I think that this is where the strength of blockchain and smart contracts really comes and shines, is where you, as an issuer, you pay back your debt and you transfer it into an escrow. And basically, as a holder of this note, this gives you a claim, a pro rata, that you have, if there's 100 notes and you have 5 notes, you'll get a 20th of what has been put in escrow, and it'll be paid out. Your token will be, which represents this note, will be either destroyed or change status. This will make it super simple and trivial to have the repayment happen as efficiently as possible. But on the other hand, if the issuer fails to settle, this is where the legal framework comes into play. Is what I alluded to in the beginning, is that in the dark times, you have you have the claim that you can enforce in court as well. So you don't need this collateralization if the issuer fails to pay. Yeah.
And the custody side, where are the investors going to hold these eNotes? Can they bring their existing digital wallet along, or do they have to use one which you provide?
So we've made the decision that customers can bring their own wallets, and we believe that we're not trying to solve a problem that is not in our domain. So and we believe that clients should bring their own wallets, and there's many companies that solve this problem very well. So, for example, we're working closely with Fireblocks to integrate their solution as well with Wallet Connect in the near future. And they have very sophisticated solutions in terms of 4i principle, etc. And yeah, we're really focusing on bringing this debt security, and we are not meddling in kind of the technology of the wallet where the user actually has custody over those assets. We're just responsible for creating the assets.
And Daniel, you've mentioned Solana more than once. Many people would think that going to Ethereum was the right and obvious choice to make. But so what factors, you touched on some of these already, but what factors persuaded you that Solana was the right choice for you to build your platform on?
Right. So we were really trying to optimize for user experience, and just the fact that Solana is able to basically almost instantly settle those transactions. You get a user experience that is very close to something like Web 2, where you just click, do your thing, and you receive instant responses. Now with Ethereum, you might have confirmation times up to multiple minutes, which, depending on the transaction complexity, if there's multiple transactions, will add up to quite substantial times, and will decrease or make the user experience less enjoyable, less snappy as such. But also there's other factors like the programming model, which to us, when we evaluated it, just seemed more scalable, and I'll elaborate a little bit. So in Solana, the data and programs are separated, right? So for example, there's one token program which is able to create many tokens, and the tokens are just specified in their data structures. Now, on Ethereum, you have standards on how to implement tokens, but they're all their own smart contract. They all bring their own program, right? And this standardization in Solana allows us to, not just us, everyone who uses Solana, to build on those standards, and through that have interoperability between programs, but also being able to build on top of those programs. So using this SPL token program, which is responsible for minting and creating tokens, we're then also able to, for example, integrate something like Project Zero, which offers an order book for those tokens. And you can choose 2 token pairs and build an order book on that. And there's many examples like this where there's managed token solutions that we can build on top of, and this interoperability is really, as we judge, second to none. And just like factors like developers, developer growth, but also wallet growth, which gives Solana a certain network effect and a certain growth metric that we also found quite attractive. Now, this doesn't mean that we're not looking to also expand later on into other blockchains. It's just that for the prime user experience that we're trying to build with this initial launch, we have chosen Solana for this, for the reasons I alluded to.
Could you, on that last point you brought up there, could I raise that question of interoperability now?
Sure.
Across multiple blockchain protocols will clearly be helpful, both to investors and particularly to investors with their different wallets and so on, but also to issuers as well. That must be vital to your long-term success. So how important is that interoperability?
So I think what we're in the short or medium term are focusing on is actually to bring in the liquidity from other chains. And there's protocols that allow us to do this, like something like Wormhole, or wrap tokens, where we're able to bring tokens from other chains onto the Solana chain. And you could imagine that if you're holding your USDC on Ethereum and you want to invest in a note on FQX, we would build a bridging mechanism with one of those protocols where you could actually fund it into an address on Ethereum, bridge it over to Solana, and have it escrowed on Solana, and also exit that way as well. So you could also exit back onto the other chain. So that's what we believe to be the most pressing use case in the medium term. But also we're looking to potentially bring the notes themselves and the programs themselves, like the issuance programs that issue those notes, onto other blockchains, potentially Ethereum. Bring those tokens itself also to those chains, but that would be a lower priority after the liquidity's been dealt with, I would imagine.
Your talk of bridges will make some people listening to this somewhat uneasy, since they have acquired a reputation for creating vulnerabilities and openings for hackers to steal your assets. Clearly, you've got a long-term solution to that, but how large does the vulnerability of bridges loom in your concerns at this point?
Vulnerabilities in bridging protocols are definitely something to be taken seriously. Before we launch any of these kind of bridging solutions, we would definitely have to evaluate them very deeply and thoroughly, and before we make any decision to integrate them into our system.
Now, I promised to come back to a question you raised earlier, Benedikt, on legal certainty. You've obviously done a lot of work to achieve legal and regulatory certainty, and in more than one jurisdiction, not just Switzerland, but I think you mentioned London, Singapore, Germany, possibly. I can't remember, you mentioned the United States as well, but how are you offering that legal certainty, and in how many jurisdictions are you able to offer it?
So I mean, to chime in here first, legal certainty is probabilistic until you end up in a court, and then it becomes binary at some point, at kind of the last instance. But nonetheless, as a system to provide trust in financial and business transactions cross-border, we can talk about legal certainty, and our framework is built on new and also existing legal frameworks that provide a basis for blockchain-based debt instruments. And so we have eNotes that can be issued under Delaware UETA, so the Uniform Electronic Transactions Act, which provided the basis for electronic promissory notes going back even to 1999. But also Singapore Electronic Transactions Act, which is much more novel legislation, or Swiss DLT register securities. We will expand this basis to also cover German electronic securities, and soon also UK promissory notes, which are blockchain-based and digital. The reason why we offer such a wide variety of legal bases and applicable laws is not because we have to offer one for each jurisdiction we want to be active in. It's very similar to, let's say, the derivatives market, where the ISDA agreements are the standard legal framework, and they are either issued under New York law or under English law. And this, of course, is accepted around the globe. It's the same with our infrastructure. You can use our eNote if you are in Singapore, and you can use it based on Swiss law, or you can use it under Delaware law. The difference is there are local proclivities to use a applicable law that you're more inclined to use, that you feel more familiar with. And that's why we offer this variability on this front. But the certainty we can offer, because these legislation offer a framework for blockchain-based debt securities. And so we have built the tech and done the legal engineering in a way as to comply with these provisions, and we can do this on a global level. The global standardization we reach via arbitration, so we can make sure that the parties wherever they may sit around the globe. If you're part of 169 countries that are member states of the New York Convention on the Recognition and Enforcement of Arbitral Awards, then you can enter into an eNote transaction. We will make sure that it will be enforced in a court of law, actually no matter where the issuer sits.
Now, this is not a legal question, but it's an interesting question in terms of additional services you might be able to offer to investors in particular. Maybe it's a question for you, Daniel. Are you planning to offer staking as a service to the holders of the coins?
So you could imagine kind of indirect staking solutions with like having your collateral staked in some protocol or something like that. But currently we have no plans to directly stake any tokens in our platform. It's features that we are thinking about with collaterals, but currently nothing concrete, no.
So an important question, Benedikt, what's the commercial model? How is FQX going to get paid? Are you taking a fee from every issuer, every issuance? Are you also taking a fee when you get the secondary market trading going from every transaction as well? How are you going to get paid? What's your model?
So I think the basis will be an issuance fee already is, as it's already applied on our current product. And here, of course, we can earn a attractive margin while still being highly competitive, right? Because we can cut the cost basis. If you think about, you look at a bond issuance where in, let's say a European market, a mid-sized company issues a bond of maybe 100, 150 million, they're going to have to pay 40 to 50 basis points to the bank, which is, $600,000 just for issuing this instrument. So we have a huge basis where we can cut costs and still earn quite an attractive margin. And so this is the basis on which we scale a business. We will have some additional ancillary services that can also be priced in, for example, potentially collateralizing or securing a transaction can cost a bit more. And then adding modularity. If you, for example, want to add an option, something we haven't talked about, we could technically also offer structured notes where you have an option element to it, where the investor gets to choose which currency they want to be paid back at maturity, which can still be done with an eNote, but technically it becomes a structured product. And so there are several elements where we can add, additional pricing. But, for us, this is not just about squeezing out the market or whatever possibility there is. We really want to create more efficient markets and just deliver customer value. So I don't think, we haven't decided that, but we don't want to curb secondary market trading by including, additional fees, just if we can.
Among the people looking forward to you scaling the business are going to be your investors. And when I looked at Crunchbase, I saw you'd raised $6.7 million from a bunch of well-known venture investors, including 6 fintech ventures. You've obviously spent some of that money on this detailed legal and regulatory research that we've talked about. Are you planning to raise more money in the near future? And if so, what would you spend it on?
Yes, so we're actually just closing a smaller round at the moment, and we will then raise a Series A next year once we have provided further proof of the huge market opportunity that we have with our product. And most of the money that we're going to raise next year will really be spent just on scaling the business. And that means just, actually adding more marketing and experienced, high-profile salespeople to the team on the one hand, but also just continuously expanding the product basis, adding features, etc. And so we have really enough to spend it on. And as with growing success, I think our team will definitely continue to grow.
So some of the money will go on sales and marketing, as it were. What progress have you made so far in terms of the number of issues that you've launched, number of investors you've attracted? What's the value and volume of the business you've done so far?
So we have, we talked a lot about the research, the infrastructure we built. So the most resources we haven't allocated on business development or sales in the past, but really on legal research and building the product, because it's an extremely sophisticated product that is far away from being trivial. Now that we've done this groundwork, actually since a bit of a time now, we have gone to market. First, we had a POC phase, so it was really about creating validation for our hypothesis that this tokenized debt instrument can be used on an institutional grade level. We've done a big pilot transaction with Credit Suisse, where they provided financing based on an eNote to 2 public companies. We've done a number more of them. And so last year we ended with still, I would say, moderate total issuance sizes. We have now, in the past half year, grown that by more than 1,000%. And so the average transaction revenue has risen and the average transaction size. So currently the average transaction size is around, a 7-digit number, so low millions. And this will also continue to grow now as we also have the first series of nodes on SDX. So it's looking good, and we just see a continuous growth, and we're looking very forward to now entering the market of really standardized tokenized debt instruments with our blockchain-based commercial papers, and soon also blockchain-based bonds.
Is one of the things you're looking forward to further international expansion? You've been very clear about the markets. You've done this heavy lifting in terms of legal and regulatory research on. You're obviously making progress in those markets. But are you planning to expand into other jurisdictions as you look forward?
Absolutely. I think the holy grail, the US market, is still up for grabs. But this is something we will do at a later stage. Because it's kind of a one-shot opportunity, and we first want to build a global brand and global trust in other markets, because we know not only is the US market still the largest one, it's also the most competitive one that already offers a wide variety of short-term financing solutions. So in order for there to be successful, we really need to have all our ducks in a row. And whereas in Europe, short-term financing is actually much less populated, and if it is, then it's mostly by banks, but very few alternative funding sources, and the same actually applies to Southeast Asia. So these are the natural markets for us to grow in the near future.
That's my last question. I'd be interested in a thought from each of you in response to it, and perhaps Daniel, you could address this first. What is success going to look like for FQX? How will you know when you've succeeded?
I think FQX has succeeded if we have dramatically increased efficiency in financial markets using those automatic issuance and settlement programs that we're currently developing. So, and having brought self-custody to our customers and give them that security and efficiency increase, that will bring, their ability to finance and get yield to the next level. I think that will be the success for FQX in my eyes.
Benedikt, do you have I'm sure you'll endorse that, what Daniel has just said, but do you
Absolutely,
have something to add to it?
Yeah, I think just really, if we get large companies and even at one point a traditional company to use our blockchain-based infrastructure for short-term or long-term debt transactions, and I think that will already be success to show that, we have brought blockchain technology to use in a way that we really think it can create value for users, and then in the end also for society as a whole, if we could just generate more efficient sources of liquidity and a more level playing field access to liquidity. That's going to be success for us.
Benedikt Schuppli and Daniel Killenberger of FQX, thanks very much for taking the time.